What's the real difference between a bull and a bear market? And how do they impact investors like John, who's trying to make sense of the market fluctuations that are affecting his portfolio? John, a young professional, had just started investing in the stock market, and he was excited to see his money grow. However, as he began to follow the market trends, he noticed that some investors were optimistic, talking about a bull market, while others were pessimistic, warning of a bear market. John wondered, what's the difference between these two markets, and how do they impact his investments? He thought of it like a game of predictions, where a bull market is like a runner sprinting upwards, and a bear market is like a downward slide. But what triggers these trends, and how can he, as an investor, prepare for them? And here's the surprising part. It's not just about the direction of the market, but also about the mindset of the investors. As John delved deeper, he discovered that understanding the dynamics of bull and bear markets is crucial to making informed investment decisions. Let's join John on his journey to uncover the real difference between these two market trends. Vocabulary: volatility, portfolio, trends, investments. What happens when a bull market takes hold? And how does it affect the average investor? To understand this, let's consider a powerful analogy. A bull market is like a rising tide that lifts all boats. Imagine you're at a harbor, and the water level starts to rise. Every boat, regardless of its size or quality, will float higher. This is similar to what happens in a bull market, where investor confidence is high, and the overall market is on an upward trend. A great example of this is the 1990s dot-com era, where technology stocks were booming, and it seemed like every company with a .com in its name was destined for greatness. And here's the surprising part. Even mediocre companies can see their stock prices soar in such times, not because they've suddenly become more innovative or efficient, but because the overall market sentiment is so positive that investors are eager to jump on any bandwagon that seems to be moving upward. This can create a self-reinforcing cycle, where rising stock prices attract more investors, which in turn drives prices even higher. As we explore this phenomenon further, we'll see how this bull market mentality can have a profound impact on the way investors make decisions, and what it means for the market as a whole. What happens when the tide turns and the market's optimism starts to fade, like a ship sailing into a stormy sea? On the other hand, a bear market is akin to this turbulent environment, where investor pessimism reigns and the market is in a downturn. Think of it like the 2008 financial crisis, where the global economy was hit hard and many investors saw their portfolios shrink significantly. In a bear market, the overall sentiment is negative, and people are more likely to sell their assets, which can lead to a vicious cycle of falling prices. And here's the part most people don't know. Bear markets can be both a threat to portfolios and an opportunity for savvy investors to buy low. It's like a clearance sale, where you can find valuable assets at discounted prices, but you need to have a clear understanding of the market mechanism to navigate it successfully. The key is to recognize that bear markets are a natural part of the market cycle, and they can be a chance to rebalance your portfolio or even invest in assets that have been oversold. So, what does it take to identify a bear market, and how can you make informed decisions during this time? Vocabulary: pessimism, downturn, portfolios, turbulence. Okay, so we've talked about what bull and bear markets look like on the surface. But now let's dive deeper into why they happen, the mechanism behind these trends. Imagine you're at a busy market selling lemonade. On a sunny day, everyone wants your lemonade, so there are more buyers than sellers. That's when you have a high demand for your product and your prices go up. This is like a bull market. It's all about positive momentum where people are buying in. But what happens on an overcast day? Suddenly, the demand drops because no one wants to buy lemonade, so you have more sellers than buyers. Prices drop, and that's when you're facing a bear market. People are selling way more than they're buying, creating downward pressure on prices. Now, in these markets, it's not just about the weather. There are other factors at play too. For example, economic indicators like GDP growth or unemployment rates can shift demand. If the government announces strong economic growth numbers, people feel more confident and start buying more stocks, driving up prices. That's a bullish trend. Conversely, if unemployment rates go up, it might signal an economic downturn, making investors nervous and leading them to sell their stocks quickly. That's when you see bearish trends forming. Here's the surprising part. These market trends often create self-reinforcing cycles. For instance, if prices start rising bullish, more people get excited and buy in, which pushes prices even higher. This attracts more buyers, and before you know it, you have a full-blown bull market cycle. But here's where understanding the mechanism really pays off. By recognizing these patterns, investors can better understand why markets are moving and potentially avoid getting caught up in them. It's like knowing when to stay out of the rain or bring an umbrella. Having this knowledge helps navigate the unpredictable weather of the financial world. So, what does it mean for John, our young investor, to navigate the market landscape and make informed decisions about his investments? Let's take a step back and look at the bigger picture. Imagine you're on a road trip and you're trying to figure out the best route to take. You wouldn't just close your eyes, point to a map, and start driving, would you? No. You'd look at the signs, check the traffic updates, and plan your route accordingly. It's similar when navigating the market landscape. John needs to look at the signs, or in this case, the indicators that tell him whether the market is in a bull or bear phase. He can look at the S&P 500, which is like a report card for the U.S. stock market, showing him how the top 500 companies are performing. He can also check the GDP growth, which is like the economy's speedometer, telling him how fast or slow the economy is growing. And then there's the unemployment rate, which is like a thermometer, showing him how healthy the job market is. By looking at these indicators, John can get a sense of the market's current temperature and make informed decisions about his investments. And here's the surprising part. It's not about predicting what will happen next, but about understanding what's happening right now. By doing so, John can adjust his strategy to suit the current market conditions rather than trying to guess what the future holds. This approach helps him make more informed decisions and avoid getting caught up in the emotional roller coaster of the market. Vocabulary: indicators, GDP, unemployment, strategy, thermometer. So, what's the real difference between a bull and a bear market? It's not just about whether the market is going up or down, but about the underlying dynamics that drive investor behavior and market trends. Think of it like the difference between a strong, steady wind that fills a sail and a fierce storm that threatens to capsize a boat. In a bull market, investors are filled with optimism, and their confidence drives prices up, creating a self-reinforcing cycle. On the other hand, in a bear market, fear and pessimism take hold, and the downward pressure on prices becomes a self-perpetuating cycle. By understanding these dynamics, investors like John can better navigate the markets, making more informed decisions about when to invest and when to exercise caution. And here's the surprising part. It's not just about predicting which way the market will move, but about understanding the underlying currents that drive it. By grasping this concept, you'll be better equipped to ride out the ups and downs of the market and make more informed decisions about your investments. If you want to deepen your understanding of how markets work and stay ahead of the curve, consider subscribing to our channel for more explanatory content. Vocabulary: optimism, self-reinforcing; pessimism, self-perpetuating; informed.